Good evening, everyone. Welcome to the December 2022 meeting of the Fairfax County Economic Development Authority Commission. I am Andrew Taherzadeh, Assistant Director of Marketing Communications at the EDA. I am your moderator for this meeting, which means I will have control over the audio functions of the Zoom call, and I will control the PowerPoint slides that will be used during the meeting. I would like to ask all those on this call to please mute their microphones or devices. And now I would like to welcome members of the commission to the meeting. Chair Kathy Lang, Vice Chair James Quigley, Secretary Ron Johnson, Treasurer Stephen Partridge, and members Rocky Mitchell, Pallavi Sabu, Joe Vitalige, and Rick Wagner. FCEDA President and CEO Victor Hoskins and Executive Vice President Alex Imes are on the call, as are EDA Counsel Mike Graff, several EDA staff members, and consultants who represent the EDA. I would also like to welcome Fairfax County officials who have joined us for the meeting. Presenting from the FCEDA tonight will be Chair Lang, President and CEO Victor Hoskins, Executive Vice President Alex Imes, Vice President of Talent Michael Batt, and Vice President of Marketing Communications Anna Nissanen. This meeting is being recorded. Members of the FCEDA Commission who have questions will have the opportunity to ask questions as they normally would during meetings. If anyone from the public has any questions, please select the chat function at the bottom of the Zoom screen to ask a question, or email Cheryl Martelli of the FCEDA. Cheryl's email address will be posted in the chat box. We will not answer questions from the public during the meeting, but we will respond to all questions in writing afterward. And with that, I will ask Chair Lang to begin the agenda. Chair Lang.
Thank you very much, Andrew, and a very good evening to everyone. Welcome to the December meeting. It really is cold out there. It really is December. We have an open session meeting planned tonight. And in addition to our regular agenda items, we will hear from Dr. Anirban Basu, Chairman and Chief Executive Officer of the SAGE Policy Group, as a part of our Thought Leadership series. So let's get started. First thing is to approve the minutes of the last meeting. May I have a motion to approve the minutes of the November 2022 meeting?
So moved, Chairwoman Lang.
Thank you very much, Commissioner Vitalige. Do I have a second?
Second.
Thank you very much, Commissioner Johnson. Is there any discussion? With that, I would like I'd like to call the question and for our council to do the roll call.
Thanks, Madam Chair. I'm going to call the roll of the commissioners who were in attendance at the last meeting to call the question on the approval of those minutes. Start with Commissioner Vigilik.
Aye.
Commissioner Sabu.
Aye.
Commissioner Hainsworth. I think Lenny may not
Absent.
be with us this evening. Secretary Johnson.
Aye.
Vice Chair Quigley.
Aye.
Chair Lang.
Aye.
The minutes are approved.
Thank you very much. And now I would like to turn over the floor to our treasurer, Steve Partridge, who is going to be giving us his final treasury report.
Yes,
He's
so
not
passing the
going
baton
anywhere.
in January. Thank you, Madam Chair.
You're very welcome.
So we're not quite through the halfway point of the year. We're at 42% if you look through the end of October and right into November, sorry. And so we're about 33% spent on budget. Part of that, if you notice in the notes of why that's the case, is there's a short-term renewal of our short-term extension of our lease, which gives us free rent October through January. So that's sort of part of the reason the budget's a little better than we would expect at this point. And the staff will be reallocating that savings into a digital marketing campaign in the second half of the year. So no red flags, anything in the budget right now. Things look good. And that is my report, Madam Chair.
Thank you very much. So, as you remember, in the fall of 2020, we began a series of guest speakers to provide the commission and staff with various perspectives about the economy. These thought leaders will help provide a strategic vision for the future. I'm delighted to introduce Dr. Anirban Basu as our guest speaker tonight. Dr. Basu is Chairman and CEO of Sage Policy Group, Inc., an economic and policy consulting firm. He served as chair of the Maryland Economic Development Commission from 2014 to 2021 and is currently the chairman of the Baltimore County Economic Advisory Committee and is the chief economist to Associated Builders and Contractors, the chief economist of the Maryland Bankers Association, and chief economic advisor to the Construction Financial Management Association. Dr. Basu earned his Bachelor of Science in Foreign Service at Georgetown University, his master's in public policy from Harvard University's John F. Kennedy School of Government, and his master's in economics from the University of Maryland, College Park. His Juris Doctor was earned at the University of Maryland School of Law, and his doctoral work was completed at UMBC with a concentration in health economics. Dr. Basu has lectured and taught at Johns Hopkins University, and his radio show can be heard weekdays on 88.1 FM and WYPR Baltimore. And now, a warm welcome to Dr. Basu. The floor is yours.
Madam Chair, thank you so much. I hope I have a chance to share my screen. Andrew, I think you were going to give me that in a moment. So I'm going to talk about the economy tonight, of course, and where we are in the business cycle and what that portends for business leaders.
Dr. Basu, just
Yes.
I allowed you access to control the screen. So now that you have access, you should be able to advance the slides with your keypad or your mouse.
Okay. Oh, I see. Okay. So let's begin then. I see. So my presentation tonight is entitled No Time to Buy. This is a James Bond themed presentation. You'll see that theme throughout the presentation. I thought I'd keep it light, though it's a serious subject, of course, the economy. I could begin the discourse on the economy, of course, in many different ways, many different places. I could talk about Russia and Ukraine, of course, and implications for supply chains, oil prices, natural gas prices, wheat prices, fertilizer prices. I had not realized until the assault began on February 24th how much of our fertilizer supply comes from Russia. I could talk, of course, about zero COVID policy in China and the implication of that for supply chains. I could talk about impending energy crises in Europe. But as it turns out, each of these phenomenon relate to something we've been talking about for many months. It is the most salient aspect of U.S. economic performance these days. And of course, that is the specter of inflation. Let me begin the story there. And I must tell you that this bout of enduring inflation has come as a surprise to many folks, including many economists, of course. Somewhere out there in America, there is a millennial who would have said, perhaps pre-pandemic, why do you even measure inflation? Why do we do it? Which is how they sound to me. Why it's always 2%? Why do we even measure it? But those of us who were cognizant during the 1970s and early 1980s know it need not be 2%. We'll get a number on inflation, of course, tomorrow. It'll be much watched by the markets. We have data regarding consumer price inflation through October of 2022, according to the U.S. Consumer Price Index. Much of the data I will show you this evening, parenthetically, are time series data. So the more contemporary data are to the right of the slide. Two lines here, again, 12-month percentage change. The line that ends at the top, that darker blue colored line, that's your all items consumer price index. Overall inflation at the consumer level running 7.7%. You can see, however, that there is some evidence that we have achieved peak inflation. Of course, the markets have been focused a lot on that. Helped explain the market rally in June and July, and then again in October and November. Perhaps even today's rally in U.S. equity markets. That lower blue card line, the lighter blue card line, I should say, is your so-called core consumer price index, all items less food and energy. We economists occasionally like to subtract out food and energy prices from such computations because food and energy prices are A, notoriously volatile, but also B, susceptible to non-economic influences like Vladimir Putin, as it turns out, but also natural disaster and weather. So it is sometimes viewed as a pure measure of inflation, certainly a more stable one that's running at 6.3% year over year. Either way you slice it, inflation running at its highest level in about 4 decades. And as I say, in part because we haven't had to deal with this for such a lengthy period, this comes as a surprise to many people, including people who should have known better. people who have access to a lot of data, but of course, many of us economists do, but also who shape inflationary outcomes in America by shaping economic ones. They actually also have a mandate to keep inflation pinned at around 2%, their target. I speak, of course, of the folks at the Federal Reserve Bank of the United States, those policymakers. Now, this bout of inflation begins to spring up during the spring of 2021. And by the summer of 2021, inflation is running at around 6% on a year-over-year basis. Here's some statements coming out of Federal Open Market Committee meetings as inflation is beginning to blossom in America during the spring and into the summer of 2021. So if we look toward the northwest corner of the slide, the official statement coming out of the June 2021 FOMC meeting was, quote, inflation has risen, largely reflecting transitory factors. Now, a synonym for the word transitory is fleeting. The notion is highly temporary. This is a function of the reopening of the economy from the pandemic, some lingering supply chain disruptions. This inflation shall not last, and we don't have to do anything about it. This inflation will disappear as the supply side of the global economy comes back to life, returns to normalcy. By July of 2021, the statement is, quote, inflation has risen, largely reflecting transitory factors. Nothing has changed. Another month has passed. Please, America, don't worry about it. We, your central bank, the Federal Reserve, have this firmly in hand. We have this under control. Please stop sending us your emails. Please stop making nasty TikToks about us. We see the inflation in the data, but don't you worry about it. It's going to go away very, very soon by September. The statement is inflation is elevated, largely reflecting transitory factors. So your central bank, our central bank, took the time to change the word risen to elevated because that matters so much. So it rose during the spring of 2021, stays elevated into the fall, but the key word continues to be transitory. Now, by November of last year, roughly a year ago, the tune is starting to change. Quote, inflation is elevated, largely reflecting factors that are expected to be transitory. And for the first time, the Federal Reserve is admitting they might have a problem. Now remember, in 2021, they think it's transitory and they act like it is transitory. They don't start increasing interest rates until March of 2022. Now they start signaling that they're going to do that late in 2021. By December of 2021, the statement is completely transfigured. Quote, supply and demand imbalance related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. At long last, the word transitory is dead, gone, and buried. But not only have they pivoted in terms of their language by this point, they have pivoted in terms of their policymaking. Gone is the notion that we can sit around and do nothing about this. Now the notion is we have to tighten monetary policy. We have to raise interest rates. Now, around that time, late 2021, there was a conventional wisdom among Wall Street economists that the Federal Reserve might have to raise rates 3 times in 2022 in terms of quarter point equivalents. The first economist of note who I heard suggested it might be 4 times is a guy named Jan Hatzius. Jan Hatzius is the chief economist at Goldman Sachs. And in December of 2021, he says, I think it might be 4 quarter point equivalents. Now, Jan Hatzius works for Goldman Sachs, so his house is bigger than mine, but he does not drive a Mustang. In any case, now the conventional wisdom is that this year, the Federal Reserve will end up raising rates 17 times in terms of quarter point equivalents, and 15 of that is already in the books, starting with the quarter point increase in March, 0.5% in May, and then 0.75% each meeting for the last 4 meetings. Now, a separate statement comes out from our Federal Reserve Chairman, Jerome Powell, after that December of 2021 meeting. He says, quote, these problems have been larger and longer lasting than anticipated, meaning we were surprised. We told you, the American people, and the business community of Fairfax County, Virginia, that these problems were simply transitory. We were wrong. Exacerbated by waves of the virus, not our fault. This is Delta, this is Omicron. We're not genetic epidemiologists or virologists, we're simply monetary policymakers, and we missed it. As a result, overall inflation is running well above our 2% longer run goal, and will likely continue to do so well into next year. Well, they got that right. Inflation is above 2%, has been above 2%. And again, these folks should have known better because they actually exercise influence over this outcome they were trying to predict, inflation. And they do that in many different ways, of course, including by shaping money supply in our country, here graphed back to 1959. Now you can see how profound the growth in money supply had been during much of the pandemic era. You can also see they're putting on the brakes. It is akin to somebody driving toward a stop sign at 90 miles per hour. Should not have been going 90 miles per hour. but the economy became overheated with just too much fiscal and monetary stimulus. And of course, the supply chain disruptions, we'll talk about that in a minute, but those have contributed as well to this bout of enduring inflation. You can also see, if you look for the far right of this line here, that they're putting on the brakes, right? They're trying to slow the car down from 90 miles per hour, or more likely an SUV, from 90 miles per hour, but they're still going way too fast. Inflation is still well above 2%. Again, we'll get more data on that tomorrow morning, and the markets will be very interested. In foundational monetary theory, there's a basic equation. It's the first equation you would learn when you get to the money theory part of macroeconomics. It's called the quantity equation, also known as the equation of exchange. I like to call it the equation of exchange because that's just downright sexier. And that equation says that when you increase money supply, two things can happen. Either economic growth accelerates, which of course is the objective, to countervail the worst influences of the pandemic on the economy, and or price growth accelerates. But here's the thing, and business people know this better than anybody. What do we know was happening during the pandemic? Serial economic lockdowns, supply chain issues, not enough workers, not enough truck drivers, not enough port handling capacity in Savannah, Georgia, or Los Angeles, California. And so the supply side of the economy could not really recover fully, did not recover fully. And so what had taken much of the burden of equilibrating that equation, not output growth, but price growth, meaning inflation. The same people who've been telling us merely transitory are the same people who basically guaranteed it would not be. Now, I'm not suggesting to anyone tonight that the only reason we had this bout of enduring inflation is because of money supply or monetary policy generally. There have been other issues at work here. And unfortunately, many of them have kept inflation higher than we would like. And this has been a global phenomenon, not simply an American one. This is from the Census Bureau's Small Business Pulse survey. The question on the table here is, in the last 3 weeks, in the last week, has your business had any of the following? In the last week, has your business had any of the following? Red line, domestic supplier delays. Now, these data only run through April, as the Census Bureau is retooling the survey. But during April's final week, 45% of small business operators said, yeah, this week, we had a domestic supplier delay. But note the thing here, for many months, the red line does not improve. And that's been the most surprising aspect of this for me as an economist, because we've been accustomed to operating in this just-in-time inventory world. If you want it, it'll be there for you just in time. But supply chains no longer operate with such predictability. And that, of course, induces scarcity. And when there is scarcity, that, of course, drives prices higher as people compete over those scarce items. The blue line, same difference, same thing, except it's foreign supplier delays. Now, unfortunately, of course, in the context of Russia, Ukraine, China, so on and so forth, the European energy crises and lack of workers in America, we'll talk more about that in a moment, we still have these supply side issues. And on top of that, not only have we had these lingering supply side issues, but the pace of recovery, economic recovery from this pandemic has been extraordinarily brisk. This is quarterly gross domestic product, graph back to 1990. So quarterly data, but presented in an annualized rate basis. Now, there's some unfortunate additional complexity on this slide. Not one, but two vertical axes. The blue color bars are indexed to the left-hand vertical axis, the red color bars to the right, and you will note that the numbers on the right-hand vertical axis are much larger to accommodate the volatility of the economy over the course of the pandemic period. Now, reading from left to right, the last blue color bar here is the fourth quarter of 2019. It is the final quarter of the lengthiest economic expansion in American history. Unemployment by this point is just 3.5%. We entered 2020 with plentiful momentum. This nation adds jobs in January of 2020, 376,000 jobs in February of 2020, shuts down its economy in March of 2020. Now, March, of course, is embodied by the first quarter, in this case, the first quarter of 2020. That's represented by the first red color bar reading from left to right. And during that quarter, despite that early quarter momentum, the US economy shrinks 4.6% on an annualized basis. That is, I say this to members of this commission, big news. That's headline information. For instance, during the fourth quarter of 2008, which had been the worst quarter of our economic lives, the US economy shrinks 8.4% on an annualized basis. So negative 4.6% print is a big deal. Unfortunately, this time around, it is merely the appetizer for during the second quarter of 2020, the US economy shrinks 29.9% on an annualized basis. That's that red bar that you're slipping to the south of the slide. And around that time, a furious debate breaks out in the economics community. What would the initial phase of recovery look like? Would it be U-shaped, L-shaped, Nike swoosh, check mark, square root, hockey stick. It was a straight up V. For in the third quarter of 2020, the US economy bounced back, growing 35.3% on an annualized basis. At no point has the supply side of the economy been able to handle that rate of growth, that level of demand formation. That's inflationary. You will note that during several ensuing quarters, high single-digit rates of growth in America in a country accustomed to growing 1.5% to 3% per annum. True, during the first 2 quarters of 2022, the US economy shrinks in real terms, grows in nominal terms, but in inflation-adjusted terms, shrinks, satisfying the technical definition of recession. It bounced back during the third quarter, growing 2.9% on an annualized basis. We're now in the fourth quarter. It'll be another quarter of economic growth, probably somewhere in the range of 3 to 4%. We shall see. But generally speaking, recovery has been very brisk. By the second quarter of last year, 6 quarters ago, American gross domestic product was above its pre-pandemic tally. Remarkable pace of recovery. So now we've talked about a number of factors explaining this bout of enduring inflation. We've talked about money supply and monetary policy. We've talked about supply chain disruptions. We've talked about the sheer magnitude of the recovery, the pace of that recovery. But to more completely explain why inflation remains elevated and will likely to be so throughout 2023, we need to talk at least about one other factor, and that factor pertains to the behavior or dynamics of the US labor market. Let's turn to that now. Now, one of the things that we get from the federal government each and every month are data from the JOLTS survey, the Job Openings and Labor Turnover Survey, which indicate that as of October of 2022, America home to 10.3 million available unfilled jobs. We have nearly 2 job openings, as you've probably heard, for every unemployed American. America is still very much the land of opportunity, particularly places so economically successful like Fairfax County. If you want a job in America, there is one waiting for you. No, let me back up. There are 2. And one of the reasons that we have such scarcity of human capital is because the size of this labor force is meaningfully smaller than it would have been but for the pandemic. And I can defend that statement in many ways. Let me use percentages. This is your US labor force participation rate graphed back to the year 1950. This is the proportion of working age Americans who are either working or looking for work. As an aside, note how rapidly labor force participation is growing in this country during the late 1960s through the 1970s and 1980s as women joined the US labor market en masse. Broadly speaking, this is a period in which America transitions from being largely about single income households to being more about dual income households. So you might remember the very popular television show from the late 1980s, 30-something, which first broadcast on ABC in 1987, featuring the trials and tribulations of these dual income household members operating in the Philadelphia suburbs. Because they're so busy with their careers, they did not have enough time for each other, did not have enough time to pick up dry cleaning. It was not the deepest show on television, but featured an unusually attractive cast, along with actor Timothy Busfield. Now, beyond that period of the year 2000, you can see labor force participation starts to trend lower. Part of this is because baby boomers begin to retire, but also young American men stop participating in the labor market as frequently. Why are they doing that? What are they up to? No one really knows. Everyone's too scared to ask. That said, as we approach the pandemic, labor participation is starting to climb. It's a very strong economy. We have that 50-year low in unemployment. And at pandemic eve, the labor force participation rate is 63.4%. It then collapses to 60.2% as 8 million people leave the labor force for various reasons, including fear of infection. It has since bounced back to 62.1%, though falling for the past 5 months. And my theory about this is it might be falling because people are running out of money, inflation, and no longer have the wherewithal to afford daycare. And so they're divorcing themselves from the labor market. It's just a theory. In any case, it's nowhere near where it was pre-pandemic and not close to what it had been earlier during the century. But not only is there scarcity because of a lack of labor force participation, but something else has changed here. What people want out of the world of work has changed over the course of the pandemic. Good Hire is a background check company out of Redwood City, California. They recently conducted a survey of 3,500 Americans, which found that, if you look toward the northwest corner of the slide, 68% of Americans would choose remote work options over in-office or at the job site work. They don't want to work in an office. They want to be remote. Cat, computer, coffee. That is enough for fulfillment, apparently, in America. They do not want to commute. They don't want to be with their colleagues. They do not like their colleagues. A separate survey finds that 57% of Americans find their colleagues to be annoying because they overshare. They take credit for one another's work. But the biggest reason why people find their colleagues to be annoying, they interrupt during meetings, which of course can happen on Zoom and typically does. Nonetheless, there's this general preference for remote work. Look at the third bullet on the left-hand side, it says 74% of Americans believe that companies not offering remote working arrangements lose major talent in the workforce. Of course, 100% of people answer that question view themselves as major talent. But the point is there's this now expectation and desire for that flexibility. But for industries like construction, manufacturing, bedside healthcare, brick and mortar retail, hotels, restaurants, so on and so forth, where services have got to be delivered in person, that creates even greater shortfall of human capital. Now, I just gave a speech last week in Traverse City, Michigan, where I passed a Taco Bell that said, "We pay daily." You work at Taco Bell that day, you will get payment that evening. And that's where we are in terms of labor market. I mean, how do employers deal with this level of scarcity? Well, obviously, they pay more for workers. This is your employment cost index for private sector workers. Again, 12-month percentage change. 3 lines here. You see the one that ends at the top, that darker blue card line? That's your wage and salary growth. It's been running around 5% on a year-over-year basis, around 5.1%. Now, to put that into perspective, for us to get back to 2% inflation, that probably needs to be growing around 3 to 3.5%. And we'll talk more about the Federal Reserve's perspective on the labor market in a moment. You see that lighter blue card line there? That's your benefit cost increase, that employment cost index. And a lot of employers have been putting a lot of money into their benefit packages because they're trying to refine their compensation packages to more neatly fit or be tailored with what their employees actually want in the environment or the context of the Great Resignation. And like many statistics, this is misleading because it's not all encompassing. Here's what I mean. Let me give you an example. My firm's name is Sage Policy Group Incorporated. Including myself, we have 12 employees. My team is working remotely from all of us, though we lease 2,400 square feet of office space in downtown Baltimore. And most of my employees are millennial economists and analysts. They are 30-somethings. Late last year, I asked our staff, let's please go back to the office. Let's collaborate. Let's innovate. Let's talk about our client experience. Let's improve the quality of our presentations. Let's make our reports more impactful. Plus, I'm paying rent. Let's please go back to the office. And they said to me, again, these are millennials, boss, and that's what they call me, by the way, because I'm not sure they know my name, but I like being called boss. It's actually a wonderful thing to be called. Boss, thank you so much for the offer. It's very considerate of you to think of us. It's not going to happen. Now, they're millennials, so as you know, they don't communicate quite so directly. They simply didn't show up. But the point is that I'm offering our employees the opportunity to work remotely, but you would not see that on this slide. First of all, mine is a very small firm. I know we've got some very large employers here tonight. But secondarily, there's no monetization there. There's no transaction there. And so there are lots of benefits that employers can offer employees that would not show up on a slide like this, including flexibility and the opportunity to work from home. Now, that red line there is the official statistic with respect to total compensation increase. And you can see again in the range of 5%. But as it turns out, these compensation increases are understated because of what I just said, but also note that productivity in America has been falling dramatically for much of the year. It grew very slowly during the third quarter, but during the first and second quarters of this year, productivity growth really slid lower. So employers are literally paying more for less output per hour worked. And so that all of that is inflationary. Nonetheless, and here's the thing, and you see this in Fairfax County, you see this elsewhere throughout the Commonwealth of Virginia, but other parts of the Mid-Atlantic region or South Atlantic region, despite these higher costs of compensation and despite shrunken productivity, American employers continue to hire quite aggressively. This is net change in US jobs, monthly. May of 2020, when the recovery from the pandemic begins, to November of 2022. November 2022, of course, last month for these data, and American employers collectively had 263,000 jobs. And you can see how consistent job growth has been since December of 2020, which was the last month that we lost jobs. We now actually support more jobs in the economy than we did pre-pandemic. If you were to compare February of 2020 employment, by that month, that's the last month before we shut down the economy, versus November of 2022, why that month, that's the last month for which you have data. If you look at the blue bar here, America now supports about 1 million more non-farm jobs than it did pre-pandemic. Now, it's non-farm because that's the way the data comes from the federal government. The farm employment data come from the USDA, the US Department of Agriculture, that are not additive to these, which come from the US Department of Labor. These red bars here represent categorical performance. So at the top of that heap is professional and business services. That's your law firms, that's your accountancies. That's a very large segment of the economy. So that helps explain why it's adding so many jobs, but also disproportionately, those segments offer the opportunity for people to work remotely. And because so many people are looking for that kind of employment opportunity, then are categorized in those segments. Below that is trade, transportation, utilities. That's your supply chain. That's your truck driver. That's your fulfillment center worker. That's Amazon and Jeff Bezos as an example. At the bottom of this list here is leisure and hospitality. That's your hotel and restaurant worker. Many hotels and restaurants want to staff up more fully, but they get outcompeted for human capital because they can't offer remote work as a general proposition. And also that's the lowest wage segment of the US economy. So that's where we are, but we have recovered now in terms of jobs back to above pre-pandemic levels. Washington Metro has not fully recovered. If you were to compare February of 2020 employment versus October of 2022, the November data are not yet available at the sub-national level. The Washington, D.C. metropolitan area has lost 15,600 jobs over this pandemic era period, or 0.5% of its pre-existing base of employment has yet to be restored. And again, you can mimic in the nation job growth in professional business services at the bottom here, job loss in leisure and hospitality. And of course, one of the things that really affected Washington Metro was the lack of global leisure travel, as many hotels and restaurants depend disproportionately on global visitation. And of course, that has been largely shut down. Even to this day, as it turns out, we don't see as much global leisure travel as we did pre-pandemic. In any case, now you might ask the question, well, Anibal, Washington Metro has not added jobs over this period. Should that worry us in Fairfax County? It should not, because the cause of that job loss is not in Northern Virginia. If you break out the Northern Virginia component of the Washington metropolitan area, again, February of 2020 versus October of 2022, Northern Virginia has added 20,000 jobs over this period, 1.3% of job totals. No, the issue here is largely suburban Maryland and the District of Columbia itself. Many cities, as it turns out, lost jobs during the pandemic as many forces caused people to move to the suburbs for various reasons, including the pervasiveness of remote work. But also, and the desire to social distance, but suburban Maryland continues to struggle economically, and that's largely a Montgomery County, Maryland story. And so one of the problems for Montgomery County, Maryland, of course, is it has to compete with Fairfax County, and generally it loses that competition. And the best example of this, of course, is in 2018 with respect to Amazon HQ2. As you know, Montgomery County is one of the 20 finalists as well, but ultimately it's Northern Virginia that wins the economic development race of our generation. In any case, it's not Northern Virginia where we have seen the weakness. More data on Fairfax County specifically in just a moment, but let me broaden this again to show you some data for regions across the country. This is employment growth for the 25 largest metropolitan areas in America, February of 2020 versus October of 2022, just to give you some sense of how the region is fared. And look, Washington Metro is at 24, but again, that has a lot to do with suburban Maryland's malaise and some job loss in the District of Columbia. It's a partially mistitled slide here, as some regions, including Washington Metro, have not fully recovered to pre-pandemic levels of employment, but many regions have. And at number one, Dallas, Texas. And I know that many people in this audience are not fond of Dallas, but Dallas, as a practical matter, has a horrific football team that is not that bad this year. But they also have been booming economically. If you look at the most recent years of Census Bureau data, regions of the country has added more people than Dallas, Texas. Governor of Texas, a guy named Greg Abbott. Greg Abbott, much of the news recently for a variety of reasons. One of these guys is very aggressive in keeping the state's economy as open as possible, even with the worst of the pandemic. I'm going to cherry pick now. At number 4 is Tampa. There's Governor Ron DeSantis of Florida, luckily presidential candidate 2024. Again, one of these guys is very aggressive in keeping his state's economy as open as possible, hewing as close to normalcy as possible, trying to retain as much economic momentum as possible. If you've ever met the governor of Florida, probably best if you're not wearing a mask. He does not like it. I'm told by his staff his worst day of the year, Halloween. At number 5, Atlanta, Georgia, it's Governor Brian Kemp of Georgia, again, also much in the news, recently reelected against a very prominent and well-spoken national Democrat, Stacey Abrams, viewed as a moderate Republican. First governor of the country to reopen its economy. Happened on April 20th of 2020. And number 6 is Phoenix, Arizona. That's Governor Doug Ducey. Doug Ducey did not run for election. He's termed out. Former CEO of Cold Stone Creamery. Again, one of those governors very aggressive in keeping the state's economy as open as possible, especially with respect to neighbors like California and New Mexico. So some governors were of that ilk, focused on keeping the economy open. Others much more fixated on the public health implications of COVID-19. You can see here at number 25, the San Francisco metropolitan area, our worst performer, still not back to pre-pandemic levels of employment. Who's the governor of California? Why, it's the wickedly handsome Gavin Newsom, himself could be a Hollywood actor, I'm told by my wife. In any case, last part of the country to open its economy. Now, you might ask the question, why are you bringing this up, Bonnie? But it's sort of late in the evening on a Monday. Why are you talking so much about this? Because it shapes the data. It shapes the data because, and to explain my perspective on these things, I will turn to the parable of Humpty Dumpty. Now, Humpty Dumpty was, according to contemporary lore, an egg, according to ancient lore, a siege cannon. But according to contemporary lore, an egg, but an egg with special characteristics, arms, legs, a face. One day, Humpty Dumpty sitting on a wall, minding his own business, public property, by the way, no trespass. And somebody comes up behind him, probably Vladimir Putin, pushes him off that wall. Now, Humpty Dumpty is an egg, so he breaks, he cracks. All the king's horses and all the king's men come rushing to put Humpty Dumpty back together again. I'm not sure where the horses were there. They've got no hands. They can only make matters much worse. But even the men could not do it. And my point is, the economy is akin to an egg. It was broken. It was cracked. But some regions of the country, Dallas, Phoenix, Tampa, Atlanta, were less broken than San Francisco, New York, Detroit. And so it's been hard to reconstitute these regions. It's been hard to reconstitute that egg, the economy, in the context of these supply chain disruptions and, of course, these labor market dynamics. So there's still a lot of repair for the pandemic transpiring, which, by the way, helps explain why we have so much inflation. Because a lot of the economy is coming back together, and so the economy is growing and it's overheated by a combination of stimulus, pandemic reopening, and of course, again, these supply chain disruptions. But again, we'll talk more about this as we go through this. Now, this next slide, same 25 major metropolitan areas, but much more important slide, and I don't have to go into Humpty Dumpty or any other fable. This is unemployment rates for those 25 metropolitan areas. In fact, I went the wrong way here. Let me see if I can go back a slide. Yeah, this is unemployment rates for the 25 largest metropolitan areas, October 2022. And here's the fundamental problem, ladies and gentlemen. These unemployment rates are far too low. And now you might be saying, to the folks of the commission, why did you invite this person to speak? I mean, first he does the Humpty Dumpty thing on a Monday evening, and now he's saying unemployment rates are too low. We love low rates of unemployment. We like it when people graduate from high school, college, or exit out an apprenticeship program and can find employment quickly. We like it when people lose a job and can quickly find a place of employment. Yes, as a general proposition, I would agree with that. I also like low unemployment. However, I like it less when you've got 10.3 million available unfilled jobs, 371,000, for instance, in construction, an industry that suffers structural shortfalls in terms of skilled workers, and when you have inflation rampaging across the countryside. You look at this, Minneapolis, 1.7%. That's too low. And the Federal Reserve looks at these data and says, I have to change this equilibrium. I cannot allow that to stand. You cannot grow an economy with low inflation when there's almost no one left to hire. Washington Metro, still not recovered in terms of jobs, and yet with just a 3.3% unemployment rate. Unbelievable, which gets to, by the way, how much the labor force has shrunk, including in suburban Maryland, for instance. So, that's where we are. And when the Federal Reserve Chairman Jerome Powell says, I want to cause some pain for the American people, that's what he's talking about. He cannot let these low rates of unemployment stand. Now, Fairfax County, same thing, 2.4% rate of unemployment, almost no one left to hire. So if you're looking to expand an enterprise and you're going to do it in Fairfax County, I'm not saying it's not worth it. Of course it is. It's Fairfax County, but 1.15 million people. Fabulously educated, enormously wealthy, all of that, very well located, all of those things with a fabulous economic development commission, the best in the country probably. Nonetheless, all of this, is expensive. Now, the lowest unemployment rate here, by the way, is April of 1998. That was when it was 1.1%. That was during the tech boom. But 2.4%, I think you'd agree, is very low and very much in the same range as where we were pre-pandemic. But here's the thing. And I don't know, James, if you had a question, if you want to ask it, please ask. Any of you, if you have a question, please just interject at any moment. So do you have a question, James?
Yeah, I do. I hated to knock you off your roll because this is awesome information and delivered so humorously. I'm trying to sort of put these three slides together, in which I'm assuming you're going to be doing yourself. But as I look at the puzzle pieces here, and having been a CEO of one of the largest tech companies in our area, is part of this the delta between these low unemployment locations and these other locations that are doing fairly better than everyone else, let's say post or in the recovery period. Has this been a distribution of workforce living location too? We obviously saw a lot of people leaving some of these high tax areas, high expense areas when they've been allowed to, oh, there you go. I was setting you up apparently, but as I'm trying to figure out how do we solve for this other than placemaking and things like that, did we lose just a lot of people moving to these zero tax locations like Texas, zero state tax locations like Texas and Florida? Beyond their politics, we definitely saw maybe politics drove a lot of people to move there too, but we were seeing people, if they could live anywhere, and remote jobs were starting to become the more norm, were people starting to move to some of these locations that were in the slide right before this that are doing so well, which a lot of those are fairly low tax state tax locations, at least the top 5 or 6, Texas, Florida. Some of these locations have very low state or no state taxes.
That's exactly right, James. So here's what I see happened during the pandemic period. So yes, we saw a lot of out-migration from the expensive coastal cities and a very expensive city like Chicago, Illinois. So, obviously Texas is a very pro-business environment and low tax state, very great demographics and the population growth, lots of opportunities for entrepreneurship. So we saw a lot of movement from, let's say, California to Texas. This is well documented. However, note that the second best performer here is Riverside, California. And again, I point out to the policymaking of Gavin Newsom. And so how does that make sense? Because one of the things that we saw, again, and that's happened within states, not just between states, is that many people move to less densely populated, less expensive metropolitan areas. So they move from Los Angeles, which is very densely populated, to a Riverside, which is more suburban in orientation, to the east and also less expensive. Now, part of that is remote work, but part of that is because here they are renting an apartment in Los Angeles, very expensive. All of a sudden, mortgage rates fall to record lows. And now I want to buy a house. I can't afford one in LA. I can't afford one in San Francisco, but maybe I can afford one in Sacramento, or I can afford one in Riverside, or I can, maybe move to, of all things, Bakersfield, which we saw a lot of people move to Bakersfield. Unbelievable if you've been to Bakersfield. So the point is, that's what we saw. So, Charlotte, Southern, North Carolina, of course. If Virginia is not the best state in the country to do business, it's North Carolina. I mean, they routinely rank first or second in terms of the, business climate rankings, whether for CNBC or other rankings. Often you'll see Virginia and North Carolina, competing for number 1. Florida, of course, no income tax. And very open, as it turns out, because of Governor Ron DeSantis. And maybe some people think that was bad policymaking and didn't pay enough homage to the damage done by COVID-19. In any case, a lot of people migrate to that state. Same thing with Georgia. Atlanta is the Mecca, and many people moving there. So lots of things explain these data. You'll see that the worst performance was expensive markets like San Francisco, New York, LA, and Washington, D.C. Metro. So yes, I hope that answers your question, but there are a lot of things shaping these data. Public policy and taxes are among them. But so too was that desire for home ownership, which I want to talk about more in just a moment. Now, I was right here now. This is interesting to me. This is Fairfax County employment by place of residence. So often we talk about jobs by place of the job, where the job is taking place. But this is by place of residence. This is asking the question, what's going on with the Fairfax County residential base? How many of these people have jobs by place of residence? So what it says here, if you look at this line, is that over the past year full trip data, which is October 2021 to October 2022, Fairfax County's residential employment base, people living in Fairfax County with a job, has increased by roughly 12,200. But if you compare it to February of 2020, when the pandemic started to undermine the economy, we're down by nearly 22,000 jobs. And part of that is because baby boomers retired in large numbers. So they're still living in Fairfax County, but they no longer have a job. They are retired. And many baby boomers retired early during the pandemic, again, for fear of infection. But nationally, about 1.6 million baby boomers retired earlier than expected during the early stages of the pandemic. It could be because their home value went up, their stock portfolio performed very well after the initial downturn in equity prices, that kind of thing. But, they're not there in the workforce anymore, which helps explain again why Fairfax County's unemployment rate is just 2.4%, despite the fact that the residential base of employment has not returned to its pre-pandemic level. They're no longer part of the labor force, and therefore they're not considered unemployed, even though they're not working. Okay, now, we're hinting at this, right? we are about to talk about the housing market because that seems like the next natural place to go. So let's talk about construction and real estate. Obviously, very important aspects of the economy. And you'll remember that during the recession before the pandemic, the so-called Great Recession, it was largely real estate driven. And by the way, I'm going to leave some time at the end for Q&A so we can have our discussion. But at any point, any member of this commission, please interject with any question. I'm happy to address them in the run of play. So I started this story by talking about inflation and interest rates. I think it was the right place to begin. Here I'm going to show you two interest rates of interest. The 30-year fixed mortgage rate in blue and the 50-year fixed mortgage rate in red, scrap back to 1995. But I'll focus on the right of the slide. You will note that during much of the pandemic period, mortgage rates at record lows, as people know. And then you can see the revenge of mortgage rates. In January, according to Freddie Mac, the average 30-year fixed mortgage rate was 3.22%. It's now roughly double that at more than 6.3%, and actually touched over 7% during a recent week. And so the housing market is faltering. I can show you some data. In fact, well, I can't, but if I invite it back, I'll show you some data on Fairfax County's housing market. Median prices are still up from last year's average sales price is up, but sales are down roughly 14%. But for much of this period, despite the fact that broadly speaking, the housing market can be characterized as entering recession, because just the last few months, we have seen home prices trend lower. During much of the pandemic period, of course, the housing market was positively surging. Here's the S&P Case-Shiller U.S. National Home Price Index. And you can see if you look toward the right of the slide how profound the growth in home prices was during a public health emergency. You can also see, by the way, that home prices are no longer rising. And what does that look like, by the way? Money supply. That looks just like money supply. So they still in the housing market through 2021, actually into 2022. During the early spring, actually, the housing market is still holding its own. It's been very recently under the weight of these higher mortgage rates that the housing market has begun to swoon. But for much of this period, lots of appreciation. And many people might look at this slide and say, oh my goodness, this looks like 03, 04, 05 all over again, but on steroids. We know how that period ended. I wonder if this period will end the same way. Maybe a bubble is about to burst. And for anyone who thinks that, I think that they're dead wrong. This has very little, if anything, to do with 03, 04, 05 dynamics. If you remember back then, one of the most salient aspects of economic life was flawed lending. That was your subprime mortgage, your no document loan. Look back at historical data and see how many Americans missed their first mortgage payment. So got the mortgage, bought the house, got the coupon booklet that we used to use to pay mortgages with, never once used the coupon booklet. And during that period, by the way, many builders, seeing that artificially elevated demand for housing, built to that demand, because a home builder, generally speaking, does not care if one pays back their mortgage, because by the time they're off the settlement table, they're done with the deal. So that house of cards had to tumble, and you can see from this price action it does. This time it's different. As far as I can tell, lending standards have been far more disciplined this time around. Moreover, if there is a disequilibrium in the housing market, it's not that we have too many homes for sale, it's that we have far too few. This is the inventory of unsold homes, vacant housing units for sale. Parenthetically, the inventory of unsold homes in Fairfax County has declined over the past year by about 5 percentage points. So this is a measure of the homeowner has left the home, home is available for purchase, or the builder has built the home, home is available for purchase. Look how much you had available for sale back in 06, 07, 08, as the lending markets are shutting down because so many Americans had found their way into mortgage delinquency or even worse, foreclosure. This time is different. Don't see much foreclosure, and we don't have enough homes for sale. And of course, as everyone knows, the Fairfax County inventory has been very tight. And by the way, if you look at sort of the best sales activity recently in Fairfax County, it's actually been for homes over $1 million, suggesting again that wealthy people are disproportionately staying in the county or moving to the county. The search for affordability is at lower price points. It's not at that highest price point. They're not so price sensitive and often buying with cash, and so they're not even sensitive to mortgage rates in some cases. Now, one of the things I want to do for you as I move toward the tail end of this presentation is I want to show you a number of leading economic indicators, because I want to pivot from a discussion of what's been going on to a discussion of what's likely to happen during the year ahead. Here's a leading indicator. This is U.S. residential building permits. That's a leading indicator because if you're a builder, you've got to pull a permit before you build. Now, the segment I'll focus on first is the red segment. That pertains to the construction of single unit structures. See how much we're building back in 03, 04, 05 as demand for housing was artificially elevated because of that flawed lending. And that gives rise ultimately to not just the housing bubble bursting, but also the Great Recession a global financial crisis, and a foreclosure crisis. And for many years thereafter, we don't build many single-family homes in America. Even during the pandemic period, when demand for homeownership was sky high, we didn't build as many homes as we would have liked because softwood lumber prices took off and there were not enough workers. And we had component shortages like garage doors and other components so that home builders could not move to that use and occupancy permit stage. Meanwhile, something is happening underneath the surface. In fact, it's happening on top of the surface. Demographics. The millennials, our most populous generation, are at long last coming of age. Ask yourself, what is the most common age in America this year? 30 years old. We have more 30-year-olds than any other age. What's the second most common age in America? 31. What's the third most common age in America? 29. 5 years ago, the most common age in America was 25. What do 25-year-olds do? Mostly weed. But they might rent an apartment, which lines up neatly with the apartment boom that we saw during the previous decade. Now they're household formation age. We have an incredible number of weddings transpiring in America this year. Now, part of that is catch up from the pandemic. You understand that. I understand that. Nonetheless, it's part of that's demographics. Some people don't get married even though they're together because they're not into that. Or some people who get married don't have kids, this younger generation, because they're not into that. They have pets that they treat like children. And they want to own a home. They want to change their lifestyle. They want a domicile. Can't find it, can't afford it. Not 3% mortgage rates, certainly not at 7%. So what do they end up doing? They end up renting for lengthy periods. The blue segment here relates to multifamily construction. That's where the strength is. Apartment rents are still rising. They might be not rising as quickly as they were earlier this year, but they're still rising in much of the country. Because occupancy is up. The multifamily segment stands to be strong. Why? Because all things being equal, higher mortgage rates are good for the rental market. So even if we enter a recession next year, I think the multifamily market stays pretty strong, at least in the Washington metropolitan area, which tends to be an oasis of stability even during the worst of economic times. So there's that. Now, this next leading indicator relates to, this next indicator relates to the commercial market. This is the U.S. office vacancy rate. So in certain categories of endeavor, there probably are too many units, too much space. The office market is one of them. And again, like many statistics, this is misleading. Why? Because it's not all encompassing. My 2,400 square feet of office space in Baltimore is vacant. I mean, I've got some office furniture in there that I bought when I started the business and it's precious to me. I've got a plant in there that I have to water once in a while, but otherwise it is vacant. There's no human being. There are no human beings in there legally. But it's not measured as vacant. Why? Because it's still leased. But as these lease renewals come up, you'll continue to see upward pressure on office vacancy rates and therefore a lack of demand for office construction, for instance. Here's another thing. 2020 was a year of dislocation for us all, including, of course, for brick and mortar retailers. I mean, we bought a lot of merchandise online, of course, that more than usual. And among the brick and mortar retailers that went bankrupt that year were Pure and Imports, True Religion, Neiman Marcus, JCPenney, J. Crew, Francesca's Guitar Center, so on, and Lord & Taylor, GNC. And with retail bankruptcies often come attendant store closures. So no surprise, mall vacancy is very high. This is U.S. retail space vacancy in American malls. Now, some malls continue to flourish, location and a great customer base, often affluent customers, that kind of thing. But many malls are not faring particularly well. So some of these commercial real estate segments stand to be quite weak. I'll give you another example. This is U.S. hotel occupancy through 2001. Last 3 bars here: 2019, 2020, 2021. And admittedly, leisure travel has come back with a vengeance, but business travel has not. I mean, look at us right now. We're on Zoom. I mean, I see Pallaby, I see Sharon, I see Steven, so on and so forth. I don't know where you are, but you're not with me, and even though I'm speaking to you. So, that's, business increasingly conducted in this fashion. And so that's not good for those businesses that, of course, cater to business travelers. And so when you look at the gross domestic product data, this is non-residential fixed investment in structures. Despite all that construction of fulfillment centers, data centers, obviously Amazon's HQ too. So there are some segments in which, some areas in which office space construction is still transpiring, despite all the manufacturing investment that we see. So we've now seen construction begin on the TSMC plant in Phoenix, Arizona, that $40 billion investment. We're going to see construction start in Columbus as Intel starts its $20 billion investment. Micron is about to start its manufacturing investment in Syracuse, New York. So this reshoring story is real. We're bringing much more production back to America, more nearshoring, so on and so forth. Even with that, building construction is down. That's what this suggests. You don't see any sign of recovery here. So again, some of these commercial real estate segments tend to be quite weak. Again, hotels, especially hotels that cater to business travelers, the retail segment, especially in malls, and then, of course, we talked about the office category. Okay, enough of that. let's go to the forecast. I promised you a forecast. Let me go to that. I hope to this point you've enjoyed this James Bond theme presentation. My name is Bond, Ani Bond. And again, I promised you some leading economic indicators. Let me show you a few more. So one of the groups that I have basically neglected to address, which is remarkable because that's 2/3 of the economy, is of course the consumer. You can't have a recession unless the consumer willingly participates. As long as they're spending, businesses are producing, and that keeps us out of recession. And so we monitor very carefully, not just what consumers are doing, but actually how they're feeling. Because the notion is that consumers are feeling good about their world, about their lives, they're more likely to spend. So we measure things like consumer confidence. Here's the University of Michigan's Index of Consumer Sentiment. How does the American consumer feel right now? They are miserable. They are angry, the American people. They worry about the national debt, now above $30 trillion. They worry about broken domestic politics. And of course, the number one thing that has them so upset, inflation, including 11.2% food inflation over the past year, 13% in grocery stores, and then the price of eggs has absolutely taken off recently. I don't know if you've noticed that. And this is the kind of thing that has them very upset. So the consumer is saying to folks, I am deeply upset. I'm very mad, especially about inflation. People ask me all the time, why do Americans drive angry? Because they're angry. And inflation is one of the things that has caused them to be angry. But they're not the only ones who are quite dire about economic prospects. This is the National Federation of Independent Businesses Index of Small Business Optimism. Question, is it a good time to expand your business? In October, only 5% of small business operators said it's a good time to expand their business, akin to what we saw in 2008. Mind you, they'd like to expand their business. But they can't. They can't find workers, can't afford workers, so on and so forth. So people are saying they're miserable. But as it turns out, these psychological indicators can be deeply misleading. For instance, we don't care how much about, that much about what consumers are thinking, feeling, or believing. We care much more about what they are actually doing. So they're telling the consumer confidence survey, I'm miserable, I'm angry, inflation is eating me up, but I cannot talk any further about these issues with you, sir or madam surveyor, because I shall be going shopping. This is U.S. manufacturers' new orders for consumer goods. That's a leading indicator because orders lead to production to distribution. You see very little indicator of the consumer pulling back. They have looked at inflation in the face and sped right through it. You know this, by the way. Airfares are 43% of the past year, and I know who you folks are. I don't know you personally, but I know you're island window people. I know that much about you. And when you sit in your island window seat, what's the one thing you're praying for? And it's not even the safety of the airplane, by the way. You don't want anyone in that middle seat, but the middle seat is always full because people spent right through that inflation. And you can see that in leisure travel, you can see that in many other ways. And that relates to the demand side of the economy. There's also the supply side of the economy. This is from the Philadelphia Federal Reserve's Manufacturing Business Outlook Survey. The question on the table is this: manufacture, over the next 6 months, do you expect delivery times to fall? Any reading less than 0 means delivery times expected to fall. The reading is below 0. So despite Russia and Ukraine and Chinese economic lockdowns and all the rest of China's home to a quarter of global manufacturing, demand seems pretty strong from the consumer. The supply side seems to be holding its own. That's why you'll find many an economist will tell you we are not headed for recession. In fact, the aforementioned Jan Hatzius of Goldman Sachs thinks there's only a 35% chance of recession. If you look at leading indicators like the Conference Board's U.S. Index of Leading Economic Indicators, recent readings have been falling. The economy is slowing, but very high readings relative to historic norms. Which takes me to my final slide. And I know people want me to wrap up, so let me get you to the summary slide here. And for an economist, you only forecast twice. I've had this bullet with me all year round. My first speech of the year is for the Maryland Bank Association, for whom I serve as chief economist. Their first event of the year is First Friday. This next event is January 6th. I said this will be a year of growth, meaning 2022, 2023, very different. Recession is coming to America. And it will be a fairly moderate recession. I wouldn't call it mild. I think they'll see a lot of damage in financial markets. That's my prediction. I'm speculating here. You will see unemployment rise ultimately by 2024 into the 5s. It could happen in later 2023 itself. I think you're going to start to see months of job loss, if not immediately, then at some point during the late first quarter, second quarter of the year, this economy is about to fall apart pretty quickly under the weight of these higher costs of capital. On top of that, the economy will remain unbalanced with supply struggling to keep up with demand. I know I just mentioned the supply is improving, but you still got Russia and Ukraine, you've got Omicron in China, you've got, what's going on in various parts of the world, North Korea, whatever it happens to be, all kinds of so-called black swan threat possibilities out there. And that, I think, would, overall, even the threats that we know about will continue to hamper supply side recovery. Along with rising wages amidst the Great Resignation, that unbalanced economy translates into higher than average economy-wide inflation about 2022, which of course we know, but also next year. And one of the things you're going to see, I suspect, is the Federal Reserve will stop raising rates next year, and everyone expects that, but they won't be able to reduce rates because because inflation won't be back down to 2% very quickly. It'll be stubbornly high in the context of, again, these supply chain issues and also this very tight labor market that has a long way to go before it's a soft labor market. And then, yes, some economists are forecasting interest rates to increase. Everyone predicts that in a couple of days, the Federal Reserve is going to raise rates by 0.5%. So it's an easy prediction. That's my summary today. I think recession is coming. Of course, I could be wrong. I'm an economist. I've left what I thought was 10 minutes for Q&A, but perhaps I'm wrong. Thank you very much for the opportunity. It has been a privilege.
Wow. That has been quite a presentation for us to take in. Thank you so much. I do appreciate your humor too in what can be very, very dense information. So I guess my question is, when are we going to see a recovery that's really going to make a difference to us in Fairfax County?
Well, I think for Fairfax County, I mean, look, Fairfax County is one of the nation's great success stories. And you might say, well, you're pandering to this audience. Well, that's part of it. But also because you have been that. I mean, look, I mean, HQ2 and all these kinds of things that are taking place in Northern Virginia generally, if not in Fairfax County. The point is that, it's really, all those success not in Fairfax County, but, General Dynamics, Innova, and all these, major employers, Capital One. An amazing success story in a region of the country that has enormous promise going forward, the sort of the capital of the free world. So what can I tell you? What is the constraint right now on Fairfax County enterprise, on entrepreneurship, on business growth? It's this labor market.
Okay.
And so what does Fairfax County need? It needs more people who are available to work. What does it need to accomplish that? It needs more housing. And it probably needs more housing in diverse price points. Because not everyone can afford a house that's $600,000 or above, and the median price in Fairfax County is above $600,000. It's very expensive, and that means a lot of people can't live in Fairfax County. They might be able to commute there, of course, but if they can find a job closer to home, they will, and therefore they won't make themselves available to a Fairfax County employer. So that's, I think, where it comes down to right now is housing policy. And I would say that in many places that have expanded neatly economically, the Boston metropolitan area, what's the constraint? People can't afford to live there. So what's the issue? Housing policy that's there. Very exclusive zoning in the Boston metropolitan area, the Boston suburbs. And so that really constrains growth. So in any case, that's what I would say. And there are some upstart competitors here for technology jobs. And the one that comes to mind, first and foremost, is Research Triangle, which still has undeveloped land, could create more housing and office buildings and so on and so forth pretty easily in a way that Northern Virginia can't because it's so fully built out in many cases. In any case, that's what I would say with respect to what ails Fairfax County. It's a victim of its own success. It's become very expensive, and now people are looking in some cases for cheaper alternatives, including people who want to work.
That you're singing our song. We understand the pressures around housing, and it's a complicated issue, in many ways. Are there any other questions from the commissioners?
Hey, Dr. Basu, with the sort of the sensitive nature for how cities and states are funded, especially in the how counties in Virginia are specifically sort of organized around financial purposes, commercial real estate is key and critical for paying for cops and school teachers and the like. A 1 or 2% change in tax rates around commercial property, which then leads to how many people were in that commercial property building to set those tax rates or to set those valuations, it would have been a big deal for us. Looking like the entire country is going to face this potentially dramatic and longer term shift on change from people working in an office. What do you see? How do you see cities pivoting economically to make up for that delta of income? Do you have any thoughts or opinions on how the shifting landscape for how cities make money economically? How do they make up those deltas?
James, here's what I think. Look, we're in a period right now in which state and local governments are pretty flush with cash. I mean, my own state of Maryland, which has a tendency to enter every General Assembly with $1 billion shortfall, enters this General Assembly with a $2 billion surplus. That's Maryland, which has underperformed, Virginia and many other states economically, and nonetheless we have this surplus. And why is that? Well, obviously the American Rescue Plan Act signed by President Biden on March 11th, $250 billion in direct financial support to state and local governments. And then, of course, on top of that, capital dollars, the infrastructure package signed by him on November 15th of 2021. And then also the pandemic did not ruin state and local government finances the way many people expected. So in many cases, people are flush with cash. So they're going to spend that cash, including on infrastructure over the next 5 years. But thereafter, you're right, you're going to see reassessed commercial tax base. You're going to see hotels are not worth as much. You're going to see office buildings are not worth as much. You're going to see shopping centers that are vacant and need to be redeveloped. Now, I must tell you, that creates opportunity, right? If you've got an abandoned office building, an abandoned hotel, you've got an abandoned shopping center surrounded by acres of surface parking, that's a redevelopment opportunity for the community. So if one of the things to do, of course, is to emphasize adaptive reuse. So if if the office building is not valuable anymore, turn it into something else, turn it into a very valuable apartment building, right? Because people want a place to live. So one is in Fairfax County, make sure that there's always communication with the best and most trustworthy developers, the ones who have the most vision with respect to adaptive reuse, which by the way is considered smart growth, environmentally friendly, all those kinds of things as well, right? These are preserving green space. That's one. But second, absent that, if that commercial real estate tax base or assessable base, that commercial assessable base declines in value, that's going to put more pressure on the residential base. And that's what causes communities. Look, I'm from Baltimore. I've seen it happen. This city was once 950,000 people. It's now less than 600,000 people. What are the policymakers in Baltimore done as population is up? They've raised the tax rates, which has done what? Caused more people to move out. It's not, I cannot imagine a future for Fairfax County like that. But of course, in 1850, Baltimore City is the second largest city in the country. But no one could have imagined this in 1850 from a Baltimorean perspective. But this is what's happened. And so adaptive use and try to find a way to keep the commercial side of the economy going, attract more people, because otherwise, ultimately, there will be more pressure on the residential tax base. And ultimately, if tax rates go up, you drive people out, and that puts even more pressure on the folks that are left.
Right.
I think Commissioner Wagner had a question.
Yeah, Dr. Basu, I was really taken by the work from home and the data on that. I was on a call with my daughter yesterday. She's about to graduate with a computer science degree, and I asked her where she's looking to work. She goes, "It doesn't matter. I'm going to work from home." And I'm like, "No, I'm not sure that's a great idea." And I had to have a whole conversation with her about how interaction with people and all, how to build a career. But from the perspective of what we do, you've seen changes in tax laws. Like right now, when I travel, I got to pay taxes in every state I travel to. And what I'm looking at is with the work from home phenomenon, I'm wondering if the entire way in which we generate taxes is going to change eventually, because you're not going to be able to connect anybody to an office. Their home could be wherever they happen to be, frankly, in terms of a work location. And I'm just curious your thoughts on where should we be going given the potential for change there?
I'll tell you this, you're right. I mean, our homes are not office buildings, right? We've massively added to the office stock in this country. We don't call it office buildings, right? They're our homes. We don't call it, but they're office buildings, right? And many of our right now in our home right now. And by the way, your daughter sounds a lot like mine, smart and stubborn. And my daughter works, as it turns out, for Amazon, but in Hudson Yards in Manhattan. They have a hybrid model in which they go in just 2 days a week. But I told my daughter, I think what you would have told your daughter, I want you going in 5 days a week. I want you networking. I want you to talk with people. I want you, really to, be part of that culture, and that's going to lead to more promotions and, a richer career.
Exactly.
But in any case, young people, many of these young people now are accustomed to the only job they've had has been a remote job. And now there's a prestige attached to being able to work from home, just as there's prestige with being able to go to work in a hoodie. And so their culture has changed. And so what that means is the tax base will be where people live, because where they live is also where they work, which means who benefits the most? Communities that offer the highest quality of life. Because if I can work from anywhere, I'm going to go to the community that offers the highest quality of life. That's why the office market in St. Petersburg, Florida is not problematic. Their vacancy rate is less than 5%. Well, St. Petersburg is attracting people by the droves. It's a really attractive community. In fact, all of Tampa is booming. Clearwater, all of those communities are booming. Sarasota to the, just 1 hour away, booming. Very high quality of life. That's who's going to win this. Also one of the things that we're going to see in Fairfax County is, we're about to invest a ton of money in rural broadband in this country. It's part of that, infrastructure package, $1.2 trillion infrastructure package. So all of a sudden now I can have broadband in Spotsylvania County that is competitive with what I have in Fairfax County. And of course, Spotsylvania is much cheaper. And so a lot more competitive pressure on a Fairfax County coming from North Carolina, from areas, south in Virginia, so on and so forth. It's about quality of life. And so issues like housing and schools, and of course, Fairfax County has great reputation for public schools, but traffic, because traffic is another thing that causes people to leave communities. So those are the kinds of issues that I would, if I were part of that Economic Development Commission, I would be thinking about if I'm thinking about the long-term future of Fairfax County. The short-term outlook is very good, of course, but the longer-term outlook is always uncertain.
Great questions. Thank you. So I think we have to wrap up. Are there any final questions? Thank you so much, Dr. Basu. This was really so fascinating, and we'll see whether your prediction about those interest rates going up is going to hold.
Yes, please try not to hold me accountable. I'm an economist for a reason. No one holds us accountable, and I like to keep it that way. So thank you very much, Madam Chair. It's been a privilege and an honor. Thank you.
Thank you so much.
Right.
Have a great night.
Thank you.
Thank you.
That was fabulous. Okay, so I have a couple of items to go over. All of the one-on-one meetings with the Board of Supervisors have been set. We will make sure you get the agenda in advance. We had a very successful meeting with Chairman McKay a couple of weeks ago, and we also want to make sure that you have a very open and an open dialogue with each of the supervisors to really hear what's on their minds. And then, of course, we do have a one-pager that talks about what we have done as an EDA. Our strategic planning session will be on January 12th from 7:30 to 12:30 at the Watermark Hotel next to Cap One's Perch. We'll have an incredible lineup of speakers. The introduction will be done by Chair James Quigley, which is going to be focused on adjusting strategic direction in uncertain economic times. We couldn't have had a more timely presentation than from Dr. Basu. And we're going to have a topic on site selection. Stephen Tarditi will, of the Director of Market Intelligence, will give us key takeaways from the 2022 Site Selectors Survey. Christopher Lloyd from McGuire Woods Consulting and past chair of the Site Locators Guild will give us insights from the field. And Catherine Cruz, Managing Director, Accenture Talent and Organization Practice, and executive sponsor of the Greater Washington Apprentice Network, is going to talk about the state of work. And then a second focus of the strategic planning session will be on branding and marketing. Our own Vice President of Marketing and Communications, and Anisinen, is going to be talking about key takeaways from the 2022 perception survey. We have a speaker from our new branding agency who will come on. And then lastly, we will have a focus on talent. Mike Badd, our VP of Talent, is going to talk about the status of the talent program and what is proposed next. We are delighted that Dr. Michelle Reed, who's the new superintendent of Fairfax County Public Schools, will be coming to talk about education transformation, skills, degrees, pre-work experience. So with that, I'm going to turn over to our President and CEO, Victor Hoskins.
Thank you very much, Madam Chair. Appreciate that. And if we can go to the next slide. So this was a very busy month, and a lot happened this month. And the really interesting thing was one of the big things happened last week. I actually did an interview with Virginia Magazine, and they wanted to do a year in review, and they wanted to know how we did. And I provided them some general information, and we're going to give them some final information after December 20th, because we have a big announcement that's going to come through on that day. We're very excited about that. I spoke at the Rotary Club. I had spoken to them before about a year and a half ago. It was an early morning meeting, really enjoyed it. Met a lot of very, very proud Fairfax County residents. They think the world of the county itself, and they feel they're in a special place. And as you just heard from Honorbon, they certainly are. It's really a blessed economy. Next slide, please. So today I actually did a bus tour with 9 city councilmen from the District of Columbia, Ray Ritchie from the EVP from the REIT Boston Properties, also Matt Kelly, who is the president and CEO of JBG Smith, and then a couple of people from Amazon, including Brian Kenner, who's HQ2 policy. And what we did was we actually toured them around Northern Virginia to look at what's changed in the last basically, decade and a half, which is a lot. And a lot of them didn't realize how much had changed and how non-competitive they'd become. And that was really what the experience was all about, just to give them an aha moment about they really need to think about a new strategy. So it was one of those very sobering moments for many of them. But I think it's going to provide a platform for us to move ahead and help them, because we need the District of Columbia and Maryland to prosper. And as you heard Anirban talking, in this region, we actually have done better than any other area in the region. Northern Virginia has, and we're the biggest economy in the state of Virginia and the biggest in the region. We're winning, but we have to have the whole region win. The next item was today. I actually was on a meeting with the group from all across the state of Virginia, talking about deal flow, and actually deal flow is down across the entire state, everywhere but 2 jurisdictions out of, I think there were about 35 on the call, as a Zoom call with the Virginia Economic Development Partnership. So it's starting to show up. And part of it's the interest rates. They're making investments stall, making decisions stall, but also supply chain issues, particularly in the port area in southern parts of Virginia. So it really is starting to show up now, the challenge of what's ahead of us. Next slide, please. Tomorrow, I'm going to be part of a group that's actually, it's going to be a pitch for many of the young companies in the area. It'll be over in the Bellow building in Tyson's. I'm very excited about the fact that we have the opportunity to do some work with some folks that really are committed to small business. It's an accelerator, and it's really provided a backbone for a lot of companies. Next slide. And on Thursday, I'm going to have a meeting with the DMV. The Connected DMV, as you guys know, is the organization that's really looking at working together with Maryland, DC, and Virginia. The opportunities that we're working on right now is really to focus on industries that are new. As I mentioned, the quantum conference that'll be talked about in just a moment. But the bottom line is that we really need to step up on exploring new opportunities for business. And the last item is I'll be doing a video on the state of the economy for 2023. And with that, I'm going to turn it over to, I believe it's Alex Symes.
That's right. Thank you, Victor. And bridging on your comment about Connected DMV, we've been working with them on the first iteration of the Quantum World Congress. And this is an event that helps to grow the quantum computing science and the quantum industry. And so what it did is it brought together a cross-section of innovators, scientists, policymakers for the first time from around the world. It took place at the Ronald Reagan Building in Washington, D.C., and kicked off on November 29th with some training courses and boot camps with for students all the way down into the high school level, researchers and business people who wanted to learn more about quantum. And then the conference sessions themselves got started the next day and ran through the day after that. So it was 3 days total. And for us, it was an incredible opportunity to work with our partners from Virginia, DC, and Maryland to highlight our region's quantum assets. And think about the universities that are here: Maryland, George Mason, Howard, Virginia Tech, the critical mass of federal research agencies and laboratories, and private sector innovation at companies like IBM, Amazon, Boeing, Accenture, Raytheon, Microsoft, Google, MITRE. All of those names were there at the conference, meeting with the researchers and the scientists and the delegations from around the world that are working on growing this new industry. And we're kind of planting our flag as one of the places in the world where it can grow the strongest and the fastest. Next slide, please. And this conference, although it was for the first time, it drew 700 attendees from around the world, including 80 expert speakers, leading science officials from countries like Sweden, South Korea, Australia, Finland, US government leaders from NSF, NIST, NSA, and private sector innovation leaders from Fairfax County, award-winning scientists from universities and research labs across the world. We want to thank Rick Wagner for the connections that he helped us make in their quantum division to help us connect them with some of these scientists and delegations that were present at the conference. So thank you, Rick. Appreciate your assistance with that. A total of 18 international delegations attended. There were great connections between them, large and small companies who wanted to do business with those countries, and from between people from different countries. And our region came together at the conference as a common team. Our EDOs were working the floor. We collaborated to deliver resources and information to the attendees, to companies about Maryland and Virginia and DC. And we had economic development officials from all of those locations, in addition to our alliance representations from Northern Virginia and suburban Maryland. Next slide. And so among the highlights that took place during the program, you can see some of the images there, including the various flags from around the world representing the delegations that were present and the embassy presences at the conference. There was a startup pitch competition to investors where these small companies and entrepreneurs could pitch their ideas, and they were competing for a prize of $25,000. One of the pitch contestants came from Manassas, Virginia, so had strong support from the NOVA EDA and our partners in Prince William County, and they're developing a technology for automated cybersecurity and compliance. So getting ahead of the bad guys when it comes to cybersecurity and quantum, before they develop ways to break in using quantum computing, they're building up the defenses in advance. So some really innovative things happening. Some of the other pitch companies were pitching cloud platform software, quantum for drug discovery. So all sorts of exciting things that this technology can do faster and better than classical computing. And of course, there was prospecting, as I said, national and international. We were helping make connections with companies that were there who were already in this region and acquainting them with programs that we have to help them grow and trying to attract more companies and attraction to the region. And that's the end of the report on the Quantum World Congress.
Appreciate that. And now let's turn it over to Mike Batt, talk about talent.
Thank you, Victor. Let's move on to the next slide. I really just have one slide here, and we'll talk in more detail next month and all these, but I think what we're really honing in on, you heard from Dr. Basu how important our role is from the talent area to retain our talent and bring more talent to the region. So we're really focusing in on three key areas. And one's a new one for us, which is really getting into the K through 12 space too. With Dr. Reed, we have now joined her alignment team and her core strategic planning team as she's working on the strategy for this K through 12 schools over the next number of years. Madam Chair Lang, we appreciate you attending this Think Big for Kids launch we just had, which is really to engage our companies in career exploration for our youth, to help them really get excited about different industry career opportunities. So you'll hear more about that as we build that programming at the K through 12 space that provides mentorship, scholarships, lots of great themes. And then higher ed, as you know, we're connected with over 100 universities across the country to try to continue to have folks launch their careers here, which we desperately need. But I want to thank Commissioner Partridge for engaging us on the advisory board for our Annandale campus. President Ann Kress has started this across each of the campuses. So I just participated in that in the last few weeks. And I'll tell you what, I'm lifelong resident. I think we all know Nova, but it's eye-opening, just the great things that school is doing. Just the fact that we have the second largest community college in the country sitting right here. I think another stat that I really love that I'm really trying to instill across our business intelligence community out to all of our companies is the fact that 70% of these students stay here. They're staying in the region. when they complete those associate's degrees or certifications, they're going on to Mason, but they stay here. They're more committed to our companies in this region. So we need to really engage them for our internships and apprenticeships. Also, another stat that was really neat, there's 4,600 students just in the IT cyber tech programming out there, which is greatly needed by our company. So we really need to engage those students for internships. And then finally, the third pillar here is with Rod and what we're doing around the military and veteran community. We just continue to build on that. We've just launched the task force partnering with the Northern Virginia Regional Commission to really help further engage our business community with all those transitioning service members, hundreds of thousands of them, not only here in this region, but nationally. So we're going to talk more about that next month and some of the strategies around that, but just know we're continuing to build momentum in all three areas. So with that, I'll, I think, move it over to Anna.
Thank you, Mike. And I'm going to go really quickly since we're running out of time here. Next slide, please. So this month was a big month. November was for putting Fairfax County name out there globally. And as you can see from the map on the left, this is where all of our messaging was seen and heard across the globe. You see 145 million in earned media value. That is the largest month probably in the history of EDA, I would say, in the past 10 years probably. But I got to tell you, about 2/3 of that is because of the opening of Silverline Phase 2. And it would have cost us about $100 million to get our name out there in Australia, in Europe, in India, you know, without that asset. So we are definitely moving toward utilizing when there are news that mention Fairfax County like this, we're going to capitalize on this. So I have some exciting things to tell you at the strategic planning retreat concerning this. So next slide, please. And as I mentioned, the opening of Silverline Phase 2 was a huge driver of headlines for Fairfax County. And as you can see from this one example, it was taken in different contexts in different media. So here it talks about how we're connecting the travel and business travel in particular. So we're really trying to look at those hooks that has to do with economic development to push the messaging out that is covered in national and international media. Quantum World Congress, we were a huge part of supporting, promoting it, leading up to and during the event. And I got to tell you, this was one of those great examples where things went viral online because it was so well received by the attendees across the globe. It was everywhere on social media. So we have really good examples on how to capitalize next year if this happens, if this event takes place, how to really bring it to the next level. But, you know, like I think Alex mentioned, all of our region came together, Northern Virginia plus the greater Washington region, to really carry the message. And we put some extra effort, and I think it's going to pay off throughout the year. Another driver of headlines was Chui Naithani's visit to India. She had an incredible trip as part of the international business investment team, and she was all over media there. I'm telling you, before the trip, we got some really good headlines, and after, there's a really cool podcast that she was sitting in. And I got to tell you, I got chills when she was delivering the Fairfax County message and value proposition out there. So happy to share that with anybody who would like to listen to it. And then last but not least, we had a huge announcement with Smart Roof, solar roofing company, really a trailblazer in the Northeast, adding about 400 plus jobs, a big one, and 2,500 square feet. So we got lots of trade coverage as well as national media on that one. So it was a really nice month to get our name out there, and we're trying to capitalize on that. Next slide, please. And last but not least, I did want to mention a new campaign that we started as the tech sphere layoffs started rolling out. And thank you to Kathy Lang for bringing this up with Victor, and we took it and ran with it. So Serena and Andrew from my team really put their heads together and wanted to put out something really viral and quick. So we did some advertising on LinkedIn and did some geofencing in those MSAs that are being hard hit for people losing their jobs currently. And we also did some very creative distribution via email marketing to targeted lists. For example, we got a list of people let go by Twitter. And so we're targeting them in particular. So this has been running for 2 weeks. We've gotten already 100,000 plus impressions. I don't have conversions for you yet, but that will be shared in more private setting. But really, Serena in particular and our team did a fabulous job with the messaging, and she did research. It's all based on research, the messaging that we use. So I'm super proud of this one. So we're going to keep it going over the holidays, and we'll be capitalizing on it in the new year to make sure that these folks are matched up with the jobs that we have here. So that was it for me today. Now back to you, Victor.
Thank you, Anna. I just want to say that, first of all, I want to thank, Rick Wagner for making someone available, because we kind of contacted him at the last minute, and his folks responded. And I will tell you this, I didn't talk, I let Alex report out on the Congress. It was one of the most incredibly enlightening experiences that I have had. It was so many brilliant people talking about ideas about this industry and where it's going. And I didn't realize the amount of work that Microsoft, was already doing, and others. It was just inspiring. I mean, I was really inspired. And I think the second thing that really impacted me were the number of nations that were there. There were 18 nations represented. I was, because of our sponsorship, part of our sponsorship was that I was able to attend a dinner at the Finnish embassy that Anna helped arrange. And we actually ended up having 65 people there. And I think there were 9 ambassadors that showed up. And toward the end, it was interesting how the ambassadors and the representatives started talking about, well, the Quantum Congress next year will be hosted at my embassy. And you can see this kind of, really kind of collegial competitiveness come out. And it was, and you could see that the nations really want to ally. It was also done during a time when President Biden had a quantum summit. So this all dovetailed together, and there were actually some bilateral agreements signed. So it was really very productive as an experience. The second thing I want to mention is this idea about going after talent that was leaving Twitter and being laid off in other places actually came from Kathy in a conversation her and James and I were having. And I got to say, I thought it was a brilliant idea. And, DCI, and our team, responded immediately, Serena, and they got it done. And I want to, compliment them on that, because as you heard from Anirban, that's the problem. You can't cash flow from an open position. You have to have a person in position working to get that cash flow. So we have to fill that hole any way that we can right now. And I'm really glad to be with a team that's ready to flex at any moment. So with that, let me turn it over to Kathy.
Wow, it's been quite a month. So we're going to close out in a moment. I just want to wish everybody a very happy holiday and a very healthy and safe new year. I will be turning over the reins to our new chairman, who will take it over in January and with new officers. And I look forward to seeing everybody at the strategic planning session in January. So with that, by consent, I think our council can help us move to adjourn.
Sure, Kathy, happy to. Is there any objection from any commissioner to adjourning the meeting? If not, the meeting's adjourned.
Thank you so much. Good night, everyone.
All right. Happy holidays, everyone.
Happy holidays.
Happy New Year.